A market trend in motion continues until a shift in the forces of supply and demand stalls its momentum. To a novice, the final collapse looks like a single chaotic instant. In reality, structural trend reversals are rarely abrupt. Reversing a major trend requires a transition period, where the prevailing forces gradually lose their grip on the price action. Analysts define these phases as distribution at market tops, where sellers quietly absorb the remaining buying pressure, and accumulation at market bottoms, where buyers begin building new positions. Because these transitions involve massive amounts of capital and time, they leave predictable geometric footprints on the chart that we can track. Identifying the specific geometry of a distribution phase and verifying it with trading volume allows for the calculation of a precise mathematical target for the ensuing move. The most reliable architectural model for this transition is the head and shoulders pattern. This specific shape serves as a primary focus because nearly every other top or bottom pattern is a minor mechanical variation of its core sequence. Mastering this single geometric progression clarifies the psychological reality behind major market reversals. A reversal pattern requires a prior established major uptrend to reverse. Without that momentum, the pattern has no structural significance. The model begins with a strong peak and normal pullback. Heavy volume here signals a healthy trend. The market then rallies to the highest peak, the head, but volume is noticeably lower. This divergence indicates buying momentum is exhausting. Structural weakness appears when the subsequent drop carries below the first peak's height, violating the sequence of higher lows. The final gasp is a weak rally on anemic volume that fails to reach the previous high, confirming buyers are trapped. This sequence maps the specific moment where supply overtakes demand, shifting the market's structural balance. Despite these warnings, the pattern is technically incomplete, and the uptrend remains technically alive until a final confirmation threshold is met. This threshold is the neckline, a support trend line connecting the bottoms of the pattern's two pullbacks. The reversal is confirmed only when the price closes decisively below this neckline. We can see this transition in the weekly bar chart for Nike. The chart shows a distinct left shoulder, a higher head, and a lower right shoulder. The transition completes at the horizontal neckline, where the price finally breaks through. The break of the neckline provides the necessary confirmation that the previous trend has likely ended. Market bottoms develop through the distinct psychology of accumulation, distinguishing them from the rapid collapse seen at market tops. While tops are often violent and fast due to panic, bottoms take longer to build as participants slowly accumulate assets during periods of low volatility. A market can fall of its own weight on sheer inertia, often requiring very little selling pressure to keep a downtrend in motion. To reverse that inertia and launch a new uptrend, prices require an active catalyst. In this chart of Forest Labs, the inverse pattern requires a massive increase in trading volume to validate the move. Notice the breakout through the downward slanted neckline. Without that explosion in buying pressure reflected in the volume, the breakout would be suspect. Markets can drift into a decline, but they must be jolted awake with capital to start a new bull run. Once the reversal is confirmed, analysts use the pattern's own geometry to calculate a minimum price objective. This calculation is based on the vertical distance from the top of the head to the neckline directly beneath it. This exact distance is projected downward from the point where the price broke the neckline. Analysts frequently overuse the term double top, identifying reversals where none exist. Seeing two peaks side by side often causes traders to assume a reversal is imminent. Mathematically, an unconfirmed double top is indistinguishable from a temporary pullback. If support holds at the middle trough, the original uptrend simply resumes. This chart of Morgan JP shows a bull trap, where prices briefly exceed a previous peak before failing, catching overeager buyers on the wrong side of the market. Anticipating a reversal before the geometry completes is a common path to significant trading losses. Professionals manage these risks by applying strict mathematical filters to any neckline breakout. A price filter might require the market to close at least 1 to 3% beyond the neckline to confirm the break is valid. A time filter, such as the 2-day rule, requires the price to stay beyond the neckline for 2 consecutive closing days before the trend change is accepted. Reversal patterns are visual ledgers that document the specific moments when supply overcomes demand. Successful chart analysis depends on the discipline to wait for mathematical confirmation rather than merely memorizing a pattern's architecture.